Hello, I'm Tom Selby, AJ Bell's Senior Analyst, and welcome to Fundamentals, where I'm going to focus on the Vanguard FTSE Developed World ex-UK Equity Index Fund. This tracker fund is one of the most popular on the Youinvest platform at the moment. It's designed to track or mirror the performance of the underlying index or basket of securities. In this case, the tracker follows the FTSE Developed ex-UK Index, which comprises large and mid-cap stocks covering developed markets around the world, except of course in the UK. The product has an ongoing charge figure of 0.15%, net assets of £2.5 billion, and sits at 5 out of 7 on the Morningstar risk rating scale. It also comes with a 5-star rating from Morningstar if you place importance on those kind of things. In terms of the asset allocation, the vast majority of the fund is held in US stocks, followed by companies based in the Eurozone and Japan. You can see the full breakdown by region in the pie chart. If we look now at the exposure to different sectors, we can see that financial services, technology and healthcare hold the top 3 positions, followed closely by industrials and consumer cyclical stocks. And looking now at individual stocks, the largest holdings are in the big technology beasts Apple and Microsoft, oil firm ExxonMobil, healthcare giant Johnson & Johnson and online marketplace Amazon. The fund has performed strongly in recent years, delivering double-digit growth and beating its benchmark in 4 out of the last 5 years. So that's just a brief rundown of the basics, but why exactly are investors buying into this tracker fund at the moment? To my mind, there are 4 reasons why this Vanguard tracker fund might appeal to investors right now. First, as the name of the fund suggests, it has no exposure to the UK economy. This helps combat a home bias in investors' thinking. That is the tendency of people to allocate more of their portfolio to domestic equities, potentially at the expense of geographic diversification. This phenomenon of home bias was explored in a 1991 academic study by French and Porter, which estimated the domestic ownership share of the world's 5 largest stock markets to be over 92% for the US, over 95% for Japan, 92% for the UK, 79% for Germany and 89.4% for France. Also, by removing the UK from the equation, the fund naturally holds more US-based stocks, potentially providing exposure to some sectors investors may feel are underrepresented in the UK, such as technology. Second, the fallout from the EU referendum vote on the 23rd of June could well be weighing on investors' minds, so picking a tracker fund without any UK exposure could be a way of alleviating any perceived Brexit risk. The performance of the tracker is also likely to be boosted if the pound continues to fall, as those exporting to the UK are paid more money for the same amount of goods or services. Similarly, companies buying stuff from the UK will pay less if sterling drops. Third, with a total expense ratio of just 0.15%, this tracker is very low cost, and keeping costs down is sensible in a low growth, potentially low returns world. And finally, if we see more quantitative easing or fiscal stimulus packages from the world's major developed economies, the market may start to price in inflation, that is rising prices. This is historically meant to shift away from lower risk bonds and towards stocks, although of course the past is no guarantee of what's going to happen in the future. So that's it from me. Thank you very much for watching and happy investing.